Okay. So, so what I want to do before we actually get into the material we want to talk about today is to run through a simple hypothetical investment scenario. So you can take a piece of paper, use a cell phone. What I want you to do is just to indicate to just write it down somewhere. How much would you want to, whether you want to buy or sell a particular asset. Now, in the first scenario, we only have one risky asset, with the average return being 10% per period, right? So it's risky, so it might go up or down, but on average, it's 10%. So on average, you do gain, right? I just want you to think, indicate somewhere like you can write down on a cell phone or write down on a piece of paper, whether you're going to buy or sell this particular asset in each period. We're going to have 10 periods, right? Now, let's say at the beginning it's $100. The stock price is $100, right? If you want, you can assume that you have like, say, $500 if you want, right? It's not very important. It's more important whether you're going to buy this particular asset, right? So let's just imagine you have some money, right? And the stock price is 100. You know the average return is 10%, and there's some risk involved, right? The risk is about, let's just say, if the return is 0.1, then let's just say the risk is about 0.3. Okay, that's kind of similar to what you would get in annual return in stock. So let's say start with 100. Will you buy, given that you know that the return is 10% in each period on average, right? So write down whether you're going to buy, and I'm going to show you a series of prices, and I want you to think about whether you're going to change your decision given what you know about this asset, right? So next, so this is 100. So will you buy? Write down. Next, it's 90. Will you buy the asset? Will you still, or keep the asset, or will you just sell it, right? Write that down. Then it's 117. Now the returns are, I actually use the return I told you to generate the number. So I'm not like deceiving you. It's really random, on average 10% with about 0.3 standard deviation. So that's the third period, 170. Fourth period, 152. Will you like sell your stocks, or you're going to hold it, right? So as I said, you can imagine that initially you have like $500 if you want to. It's not very crucial in this case because in typical finance model, we don't usually limit borrowing anyway, right? So you have enough money. So your decision is really just whether you want to buy or sell. Then the fifth period is 197. I think at this point you don't actually need to go through the remaining periods, but I'm just going to show you, right? Because I think at this point it's 177, and then it's 160, 208, 187, and finally it's 168, right? So I want you to indicate, I wanted to write down what you would have done in each period, and then we can think about what sort of decision process you have gone through, right? What exactly have you done? So that's the first one. So I hope you have written down what you have done, given the numbers you see each period, right? So stock price do go up and then go back down, as in the real stock market. You can see that obviously in the long run you do gain, but in the short run you might lose, right? So okay, so that's the first hypothetical scenario. The second hypothetical scenario, you actually have two assets, right? One has a higher return, the other has a low return. You don't know which one is which one, but you do know that one has higher return than the other. Now the variance is about the same. Variance is about the same. I think the one with low return has slightly lower variance. Like, so the higher return has slightly higher variance. The one has lower return has slightly lower variance. The higher one is actually the same, right? Like it's 0.1 0.1% return in each period and 0.3 standard deviation. Right. So now you have two assets, right? And now imagine you have $100. Or as I said, if you think 100 is a bit hard to think, then you can use 500. But with 100, basically what you're doing is a fraction, right? Basically, I'm asking you what fraction of your wealth you're going to put on each asset, right? Something like, is this like 50-50, 60-40, something like that, right? Okay, so initially it's just I normalize it to 100. Then what will you do, given that you don't know any additional information? How would you invest, or will you just keep your money and wait for the next period? Up to you. All right, this is the second period. 130 for the first asset, so it has appreciated. The second asset has depreciated to 90. What would you do? Okay, so write that down. Next, like the first asset has depreciated to 117. The second asset has depreciated further to 81. Now, what will you do? Do you buy? Do you sell? Like, which one do you buy? Which one do you sell? All right, so the market is tanking. So 100 is 105, and the other one is 73. What will you do? Down market. Right? It keeps going down. It's random, so it could happen. But the second asset has appreciated now. They are not correlated. Okay. Right. Doesn't look good for the first asset. 85. The second one is now 105. Then it's 76 versus 126. What will we do? As I said, in the previous case, I think at some point it's kind of obvious what you want to do, right? So then it's 69 versus 113. I have to make sure that the math, the random generator is actually, well, it's possible that this happens given the numbers that, and then it has to keep going down, and then one keep going up. It's possible that I made a mistake in the formula I use, right? I mean, like when I type in, maybe I'm making mistakes. But in any case, I think it's quite obvious what you want to do in this case, right? Okay, finally, okay, vindication for the first asset, but the second asset has also appreciated. All right, so now exercise like this actually can give and show you a lot of interesting behavior, right? Especially if you do this with real money with people, right? For here, as I said, I'm going to focus on what you buy and what you sell, right? So that's what we focus on today. There are other behaviors that we can get out of this particular exercise, like, for example, what idea you have, what idea you get out of the time series of data, like which one do you think is the one that has a higher return versus when do you make, how certain are you at each period about which asset is the better one? So that kind of issues are also very interesting that we talk about later on in the term. At this moment, we're focusing on whether you buy or sell and which one you buy or sell. Right, so we're gonna first some definitions. Now, suppose you brought 100 shares of HSBC at $80 per share, right? And that's here, right? This here. Now, if HSBC is now $90 per share, you are making a profit, right? You're making a profit. Whereas, so let's just say you buy 100 shares and you sell 60 shares. Then the percentage of gain realized is 60%. So this idea is something we're going to use in for this part of the course. It's this idea that you have that you sell part of your shares and we calculate percentage. Let's say you sell the remaining at a loss, right? Say here is like about $76. Then those shares are being sold at a loss, so that we can calculate a percentage of loss realized. All right, so that's the idea. We want to calculate how much of your holdings do you sell at a gain versus how much of your holdings you sell at a loss, right? All right, so can anyone explain to me what you did in this case, right?
I bought one share per each in the first 4 periods, and I held it.
You held it to, okay, you bought some shares gradually, and then you hold it to the end, right? How many people actually just use this strategy, hold it to the end? How many? Okay, no. What do you do? Sold in period 3. Okay. Then do you buy it back? No. So you're still selling at a gain, right? Okay. So but you didn't buy it back. Why? I mean, if like what? Okay. Okay, that's very interesting because despite the fact that I told you this is completely random, with an average of 10% return per period, you kind of still try to figure out whether there's some movement that you can predict, right? Which is very interesting by itself, right? Like anything else? Anyone have some different strategy? So the period 4, okay? You never buy back. So you still sold at a gain, right? You never brought it back, right? Okay, so that's okay. Anyone else have something different? Like anyone's actually started to sell it, like anyone actually buy it, let's say in a late period and sell it at a loss? Anyone so unfortunate? Okay, but so we have some strategies, right? People sell at a gain. A lot of people. It seems like it's quite common. It's very common for people to sell at a gain, whereas there are some people who hold it to the end, right? So that's the first one. What about this one? What do you do? This time, it's not about just selling at a profit, right? It's also about how you actually spread your wealth across the two assets, which have different return. What do you do? So when do you start buying the second asset?
Yep.
At the beginning?
At the beginning.
And then you hold it to the end. What about the first one? Do you actually buy any in the beginning?
Nope.
No? Wow, you're lucky. Okay, so you just hold to the end, basically. Yep. Anyone else?
I bought asset 1 in second period, and I held it to the 8th period before moving.
You hold it to the 8th period,
yes.
And then? You switch to the second one. Well, oh, okay, I guess you gain a little at least here. Right, anyone else?
So I put $30 in one and $30
Huh?
in the other.
And then?
I held it until the 3rd period, and then I put $10 more in each one.
And then?
And then in the 6th period, I shifted most of it towards the second half.
Okay.
And then each period I shifted
more into the second. Right. Like, so how many people have this behavior that as you see the return of the second asset is, well, obviously better, you start switching to the second one? Like, I'm very interested. What do you do again? What do you do in this case? The second one. Okay. Well, I didn't actually tell you which one is 10%, right? But it's from the time series of data you observe, the second one seems to have a higher return. So which one do you actually put your money in? Yeah, but do you switch between them, or do you just hold both of them to the end? Okay. All right. Okay. So, all right, we have a variety of behavior. Some people would obviously, or some people switch to the better one, right? Like the perceived better one. Well, some people realize that belatedly that's the better strategy, but yeah, then do that. Whereas some people are lucky in that case. You just hold to the end. Now, right, so we see a variety of behaviors here. Now, I'll tell you what happens if you look at this from a large scale. Like, so this is Terence O'Dean's data. I think I've mentioned this. So Terence O'Dean obtained this data set of trading records from a U.S. brokerage. It's a discount brokerage, so it's mostly small investors. It's the first data set, such data set, right? Before Terence O'Dean, we don't really have records of individual investor investing. So this data set has given up a lot of insight of what people do in trading, and this is one of them, right? So this diagram shows you the ratio of percentage gain realized to loss realized, right? And so literally this, right? And what do you notice? Do people sell at a gain more often, or do they sell at a loss more often? Gain, right? It's quite obvious, right? Gain. Now the horizontal axis is months in a year. There's a reason why he does that. Well, obviously he does that because of the trend you see. For most part of the year, you would see people selling at a gain way much more often than a loss. Right? At the beginning of the year, it's 2 to 1. It's like 2 to 1, right? That means that if they have 100 shares, 67 shares will be sold at a gain, and only 33 shares will be sold at a loss, right? So that's what it means. Towards the end of the year, and then it becomes almost 1 to 1. Right? Now, so gains are realized a lot more than loss. The question is, why? Why are small investors so much more willing to sell stocks at a gain than those that lost in value? Is this the rational thing to do? Now, if you just put aside at a moment the exercise that the hypothetical investment I asked you to do a moment ago, if you just if people just throw this question at you, like, should you sell at a gain or sell at a loss? What would be your response? You would probably respond saying you want to sell at a gain, right? Who wants to sell at a loss? That's why I want you to go through the hypothetical investment scenarios just now. Because if you think about this problem carefully, it's not obvious that you would expect a lot of selling at a gain versus a loss, right? Based on the two scenarios I've presented you just now. If you believe the stock market is random and on average the return is positive, the optimal strategy might be just to hold it until the very end, right? There's no obvious reason why you must sell it or buy or sell within a given year. If you truly believe it's random and then on average you get 10%, the best thing to do is not to try to predict anything and just hold it, right? So now, even if you believe the stock market is not necessarily random, in the second scenario where you have multiple assets, right, you would still not expect yourself to mostly sell at a gain because of the behavior some of you did. You would, if you're rational, you should be moving money out of losing assets and move the money into gaining assets, right? If I tell you one has 10% return, one has 5% return, or perhaps I even tell you one has 10% return, the other one has negative 5% return, right? Once you figure out which one is the negative 5% one, you would obviously switch money out of that one into the one with a high return. So once again, it's not obvious that it would be rational to always sell at a gain. Because if you always sell at a gain, if you mostly sell at a gain, that means you're probably not moving money out of assets that are giving you poor return, right? If in the case I presented you, you should have quite a bit of selling in terms of, because you want to sell the losing assets and move to the winning assets. So this is not obvious whether it's rational. Even though if you don't think about this problem carefully, you would think, yeah, it's very obvious that you want to sell at a gain. But actually, no. If you think about this carefully, you, as a part of portfolio balancing, you would want to move out of losing assets and into winning assets. So it's not clear why you would always sell at a gain, right? Okay, so now.
So you mean that in order to switch from the losing asset to winning asset, that means that we have to sell at a loss?
Yes, right. Unless you think, unless you think the stock market always goes up, like every single asset never lose money, right? Otherwise, whenever, at the minimum, if you think the whole market is going down, you should move your money out of the losing assets and just put it in your bank, right? And we know stock markets do go up and down, right? So if I place you in 2007 or 2008, like, right, I place you in 2008, with the benefit of hindsight, I think it would be a really wise idea to sell in all your assets and just keep the cash, right? Even though your assets might have already lost some value, it's still a wise decision to sell whatever you have left and then keep it in the bank, right? So unless the market really never tanks, which is not true, otherwise it's a good idea, right, to sell it in the downturn.
But the conclusion that the sell at the gain is not rational is based on the hypothesis that we know the market is actually going up.
Right. Yeah. So what I'm gonna show you is, well, now, do investors actually have a very good idea of how the market's moving, right? Perhaps they are really good. Perhaps they're not.
For individual investors, do they tend to think portfolio basis or more just individual assets?
That's also a very good question. I think the evidence points towards individual assets. I think that the evidence probably points towards that. Right. Yeah. That's true. That's correct. Which is part of the bias that we want to investigate, right? Because if you are a rational investor, there's no reason why you're not considering your portfolio as a whole versus individual assets, right? Everything should be put in light of the fact that you have that much money which you can move around. There's no reason why you should have to treat each stock individually. What you mentioned is called mental accounting. Like that people just have this mindset that, okay, stock A is stock A, stock B is stock B. I consider them separately and not as a portfolio as a whole, right? But yeah, that's a behavioral bias in its own. Yeah. So now, right? So this is from Terence O'Dean's data showing you tracking the stock performance after an investor purchased or sold a stock, right? So these are averages from all the trading records. Now you can see that it's quite clear that these investors are not particularly good with market timing, because after they buy a stock, on average the stock price declines, right? Which is to say, they are probably better off not buying. Similarly, after they have sold the stock typically goes up in value, which means that they are better off not selling. So based on this data, there doesn't seem to be any evidence that these investors are good at market timing, right? They seem to be selling too early, and perhaps they shouldn't be buying. They shouldn't be buying at this moment at all, right? So what this says is there is reasons to doubt whether the investors are doing the right thing, right? And plus what we have just did, right? In general, there's no reason why you want to just sell it again. If your asset is performing poorly, you want to clear it out, move to something that is performing better. Right. So what we want to explain is, why is this happening? This is quite well documented. There's not much controversy of whether this actually exists, because first, we have more than one database of such records besides the US one. We also have Northern Europe one, and there's a Taiwanese one, I think. So there are a few data sets, similar data sets, which I think you would also find something similar. And I think from an intuitive, if you just think intuitively, I think you can all think of people who do that, right? If me, I'll probably think of my mother-in-law. Like when she buys a stock and it goes down in value, she's never going to sell it, right? If you're local, think about there's a stock. Think about this. There's a stock there's a stock called PCCW. This stock was very famous for how much it declined in value. It's a blue chip stock. It's a big stock, but it keeps declining in value, and people keep holding it. So basically, it's and you pretty much lost everything if you do it that way, and plenty of people do it that way, right? And just I think example that always work in any period is something like companies like HSBC. A lot of people in Hong Kong love HSBC, and they basically price insensitive. They just keep holding HSBC, right? Even though HSBC has declined substantially from its peak many years ago, right? People never ever sell HSBC, right? So I think this behavior is very common, that people want to sell the gain, right? Just talk with someone who invests stock. Now you probably don't want to talk with professional investors. You want to talk with people who are investing as a non-professional, right? And I think this behavior is very common. So what is happening? So possible reasons behind disposition effect. Actually, want to talk about tax deduction first, because this is completely rational. There's nothing irrational about this particular part. Tax deduction can explain this slope. Do you know why? This actually doesn't work in Hong Kong, but it does. This is a U.S. data, so it is an important part of people's life in the United States. So now, okay, so the way it works in the United States is different from Hong Kong, because in Hong Kong, the fiscal year for tax report is not the same as the calendar year. But in the US, it is the same, right? So when you file for tax, you file what you have earned in the calendar year, all right? So which means December is the end of the reporting period, okay? Now, in the United States, you have capital gains tax, which is to say you pay tax on investment return. It's 15%. So in Hong Kong, we have no capital gains tax. So in Hong Kong, when you earn money in the stock market, you pay exactly 0 tax, right? Which is also why if you are Li Ka-shing, you would not take any salary from your company. You would want to earn everything through dividends, right? Because dividends would be tax-free, right? Unless you're holding it with a company, because if you're holding it with a company, then the dividends the company earns would be its income, right? So that would be tax. But if you're individual, you hold stocks, the stocks pay dividend, the stock gained it in value, you don't pay any tax in Hong Kong. That's not the same in the United States. In the United States, dividend get taxed. If you sell a stock at a gain, that is taxed. That's the whole point of capital gains tax, right? Your capital appreciated and you get taxed. Yeah, so given that the gain in your portfolio get taxed, why would people want to sell losing assets towards the end of the year? Right, that's exactly the point. Because the loss would cancel out the gain. You're being taxed on the overall portfolio, right? So if you realize your loss towards the end of the year, then it would cancel out the gains that you have made in the year. This is the reason why this curve is downward sloping and reaches parity towards the end. People are realizing the loss to cancel out the gains they made in the year. So that part is rational. This is completely rational, right? But it still doesn't explain why why the ratio is over 1 for most part of the year, right? So that part is unclear what is happening. Now, in general, if people are selling at a gain versus a loss, so in other words, people are unwilling to sell at a loss. One way you can argue that's rational, right? One way that you can argue that's actually rational is if you believe in mean reversion, right? If you believe what goes down must come back up, then the rational strategy is to hold losing assets, right? Yeah, that's what you thought, right? Now, we haven't reached this part. In next lecture, we will talk about this general stock price movement. And in general, mean reversion is not true. Average stock return do not exhibit mean reversion. So what goes up tends to go up for a while, and what goes down tends to go down for a while. Mean reversion might happen over a longer period of time, but is not as something that happens in a short duration, right? So this could happen, but this only happens in a relatively long run, not in a short run. Like on average, you don't see mean reversion in a month or two. You're talking about at least a year or over a year before you see mean reversion. So what we could focus on is prospect theory. We also know that this is an explanation that we can rely on later on because people actually run experiments to see whether you can generate this effect in the laboratory. Okay, so disposition effect is the idea that people are much more willing to sell at a gain than at a loss, and prospect theory is a major theory being proposed to explain this behavior. So how do you get disposition effect from prospect theory? Once again, remember the data came from was collected by Terence Odin, was obtained by Terence Odin. So he wrote this paper and he needed an explanation. Okay, so this is very typical of behavioral finance, right? Behavioral finance as a field, it's very much about finding stock market anomalies, empirical anomalies. That is, something weird in how stock price move, or something weird in how people trade, right? I think, in my opinion, a lot of the times people look for anomalies and then try to find a way to explain it away, right? So in this case, I think that's probably exactly what Terence Odin did. In his data, he realized there's such an anomaly, and he wanted a way to explain it. So the explanation he came up with is prospect theory. How? Take a look at the diagram that I've shown you in previous class. This diagram has a concave part, right? A concave part in the gain region and a convex part in the loss region, right? So you are risk averse when you gain, and you're risk seeking when you loss. Okay. If you look at this diagram, what would be a very easy explanation for people selling their stocks after the stock appreciate in value and keeping the stocks after the stock has depreciated? Let's say you're here. The stock price goes up. Now you're here. Are you risk seeking or risk averse? This is a concave, reverse, right? So, stock price gain, you become risk averse. You become risk averse, you don't like stocks, so you sell. In the loss region, you become risk seeking, so your appetite for risk goes up, So you keep your stock. That is essentially Terence O'Dean's story. Literally, I think he used this diagram and tells such a story in words, right? Terence O'Dean is a empirical finance guy. He is not a economic theorist, so his specialty is not doing economic theory. So he just have this idea, this diagram, and he's like, look, it makes sense, right? Like when you gain, you become risk averse, so you sell. When you lose, you become risk seeking, so you buy. If you follow this logic, you would get something like this, right? So this is so basically what you have is let's say this is the original stock price. If the stock price goes up, then your demand would go down, and if the stock price goes down, demand would go up. So if you follow the logic of Terence O'Dean, because you become more risk seeking when the stock price goes down, so you have loss, so you have suffer a loss, you become more risky. And if you have gain, if the stock price goes up, you gain, so you become risk averse, so you're less likely to buy stock. Something very interesting about this particular value, this is just calculated from a mathematical model, not actual behavior, is that you do see that it's slightly going up, right? You see this. So there's this big difference, which corresponds to a story that people become more risk averse after gain and risk seeking after loss. There's a part where it's going back up slightly. Do you know what's happening? This is what Richard Thaler called house money effect. In a casino, when a gambler wins, do you think it's more likely or less likely he's willing to continue to gamble? More likely, right? That's called the house money effect. The reason is that you feel that you have money that you can spend because those money you have gained and it's not out of your own pocket. So that's what's happening here. Because basically, you can say the investor is gambling with money that he gained from the appreciation. So that's why it's going back up, right? But this is a particular. This is I have to emphasize is based on just a simple analysis of the model, without careful consideration of actual possible whether the actual returns in the stock market make sense in this case. This is a wealth effect, right? Because now I'm going to tell you the whole story doesn't work actually. Terence O'Dean's story actually is wrong. Because Terence O'Dean simply looked at the diagram and think it makes a lot of sense, but actually it doesn't make sense especially if you think about how investors started investing to begin with and realistic returns that you can get from the stock market. Right. So what's the problem? Actually, it's very easy to illustrate what's the problem if you think about the whole process carefully. Right. The problem is loss aversion. Right. Now, Terence O'Dean is only focusing on the part, the diminishing sensitivity part. Right. He's only focusing on the fact that the gain part is concave, the loss part is convex. He is not considering the kink at all, which is the strongest effect. The kink, if you look at the kink, it basically makes the whole curve concave, which means the individual is highly risk averse when he decides whether to buy stock at all, right? This, if you look at this, right, this is highly concave, right? Much more so than what you have here. So, okay, I can illustrate that with the diagram. Now, let's just say this is the distribution of return. Like you could gain, you could lose, right? And an average would be somewhere along this straight line, joining 2 points. Now, if this is a 50-50 gamble, right? So the stock price goes up half the time, stock price goes down half the time. The individual might not want to invest at all, right? Because the utility of doing nothing is higher, right? The vertical axis is utility. The utility of doing nothing is higher than the utility of buying stocks. Once again, what's happening is the loss aversion, the difference in slope, right? The difference in slope in the gain region and the loss region makes the individual actually very risk averse here. Intuitively, if I don't like to lose money, then I don't like the stock market unless it's very, very high return. This is the whole point of what we talk about, the equity premium puzzle. People are not investing because the stock market looks like it's very risky. So this is actually equity premium puzzle. You need very high return to entice people to invest. So, right? So now, Barbaros and Sean. Sean is, you think about name, it's kind of Chinese, right? So Chinese are good at math. So they had this paper, What Drives Disposition Effect, and analysis of a long-standing preference-based explanation in Journal of Finance. This paper is actually a lot newer than Terence O'Dean's paper, because Terence O'Dean's paper was in like 1998. This paper was 2008. It took 10 years for people to figure out that there's something wrong with Terence O'Dean's explanation. 10 years. Right? No one actually realized there's something wrong with this explanation. So Barbaros and Sean did a much more careful calculation based on more realistic numbers, including realistic utility parameters, realistic stock returns, and think really carefully about how a trade would work. And they realized actually people would not buy in many cases. If the annual stock return is something around like less than 10%, and the number of trading periods within a year is not too high, then they actually don't want to buy. Which, once again, is actually just the equity premium puzzle, right? We know the average stock return in the stock market is quite high, yet a lot of people simply do not invest in the stock market. So this is actually what we already know. It's just that people didn't link up the two problems. So it doesn't actually work. If the return is too low, people simply do not buy. So you need the return to be higher in order for the individual to buy at all, right? So you need the average to skew towards the high end. So now this does work because the utility of buying stock is now higher than the utility of doing nothing. Okay. Now, what happens if the individual actually benefit from appreciation in the stock value, right? So now he's here, right? The stock price has gone up, which means his wealth has gone up. And now if you look at his investment decision again, once again, it could go up, it could go down. The return is skewed towards the positive side. Here's the problem. If it is actually, the return is so high that he's going to start investing, there's actually no guarantee that he will want to stop. The curvature here is typically not strong enough to overcome the attractiveness of the high stock return. The estimated curvature here is actually quite shallow, right? You can see it's almost flat, right? So people are actually only very slightly risk averse in the gains region. If the stock return is high enough to entice them to start investing, then it's strong enough to keep them, just like what you did in the first example, in the first scenario. The stock price, it's 10%. 10% is enough to entice you to start investing. 10% is enough to keep you investing in the gains region, right? So, yeah, that's what this is. Now, when the number of trading periods is low, the numbers shown here are percentage gain realized and percentage loss realized. The percentage gain realized is actually 0 if the number of trading periods are low, because, well, it's as I said, if the return is so high, the rational thing to do is actually not to sell. Right. they have a lot of other things happening in these numbers. All right, so I've explained this. Why I've explained this only. This is a very complicated table, and I've only explained one part of it, which is two parts in total. Return too low, you simply don't start investing. Equity premium puzzle. You turn high enough that you start investing, then it's also high enough to keep you to continue investing, so you're not going to sell. So I've explained this part. Now, there are other things I haven't explained, like because this is percentage gain realized, this is percentage loss realized. I haven't explained why they would act the percentage loss realized is actually non-zero. Because this is a percentage, right? So if you sell a tiny bit, then and you never sell it again, then this would already be 1, right? The two numbers always add up. I don't even, do they actually always add up to 1? They don't actually add up to 1 in these cases. I'm not sure how they teach the numbers, but this one is very simple. No, they never sell it again, and they sometimes sell at a loss, so that's why this is 1. I haven't explained why that's the case. So what happening is in this with the prospect theory model, when the stock loses value, you actually want to slightly reduce your portfolio. You actually want to do that. If this is a binary decision of buying versus selling, that you don't have a choice of how much to buy and how much to sell, then this would actually be 0 and 0. If you actually, it's a binary choice. If you only can choose buy or sell, but cannot choose how much to sell, then you would not want to sell because you have become more risk averse. More risk seeking. But if I give you the option of how much to sell, it's actually optimal to sell a tiny bit. Actually sell a tiny bit. The reason is, if you look at this model, and imagine that you are here. Now, because the stock return is not symmetric, the amount you lose is not the same as amount you gain. So let's say you're here right now, then you might end up, if you keep investing a lot, if you're investing a lot, let's say, then you might be here, right? Something like this. Something like this. If you invest a lot, then you might be in this scenario. But if you slightly reduce your investment, you would be here. See? So the reason is that, once again, it's because of the kink. Because of the kink, it actually, the optimal strategy is to keep yourself within the convex slot and don't extend yourself to the gain region. Once you extend yourself to gain region, you can see the red line is actually lower than the green line because this has the slope here is lower. So you can see that this line is lower than the green line. The optimal strategy is actually keep yourself in the convex region and not extending yourself to the part where the slope starts going back down. In the convex region, the slope keeps going up. So you get high utility from taking on risk. But once you extend yourself to the gain region, this slope actually starts to go back down. And the utility you get from taking on risk also goes back down. So the optimal strategy is actually not to extend yourself over to the gain region after you have lost. But these are details that you only realize if you're really being careful with the model. Because if you just think about it, you might not realize that this is happening. After you lost, you might not want to actually gamble yourself all the way back to the gain region. You just want to keep yourself roughly in the convex region because you can see the green line is higher than the red line. So this is only possible if you can choose how much you invest. If you can choose how much you invest, you would scale down your investment such that it's barely kind of inside the convex region, right? But if it's a 1 or 0 thing, it's either the red line or nothing, then you will obviously choose to invest the red line, right? So this is investing a lot. This is investing a little. This is not investing at all. if you can choose between these three options, you would want to invest a little. But if you have only a choice between investing a lot and not investing, then you would choose investing a lot. Well, because if you think about stock as a binary outcome, it's either up or down. Then this is the utility. If it goes up, this is utility. If it goes down, the red line gives you where the expected utility would lie on.
Middle of the line.
It's going to be it's going to be somewhere in the middle of the line, depending on the probabilities, right? If the probability is skewed towards the gain side, then the weighted average would be closer to the gain side. But it's always going to be on the straight line joining the two binary outcomes. It'll be in the middle, right in the middle. Yeah, yeah. Right. Right, right. But basically, the idea is you can see the green line is higher than the red line, so it's not necessarily optimal to gamble all the way to the gain region, because
that is to say, for higher utility, we need to keep our portfolio small enough to keep our utility at the
convex region. Yes, right. It's yeah, well, I'm drawing it very extreme in this case. That's true. It's in this case, yeah, probably, but I mean, I'm not drawing it very accurate too. So that's why it's not easy to spot such problems unless you do this very carefully. The distance here is not scaled correctly, right? The red dots probably shouldn't be that far away, right? So, but if you do this mathematically, then yeah, you can. This problem is obvious. I mean, if you just think about this, the problem is I can't draw it too close because you can't see the difference. But really, what's happening is you think about like just either slightly on the left of the kink versus slightly on the right of the kink. Then slightly on the left is actually better on the right, because the marginal utility you get here is higher on the left than on the right. Your utility from because the curvature is going back down, so it's actually not as good for you. Yeah. The marginal utility from taking on additional risk is going back down. Whereas if you are keeping yourself in the convex region, the marginal utility from taking on additional risk is going up. Right. Yeah. So this is once again these are subtle points of the model that you might not realize unless you're very careful about the model. And Terence O'Dean is not that careful. He's just thinking about this diagram and thinks there's a story that makes a lot of sense. For 10 years, people think it makes a lot of sense. And only until this paper do people realize, wait, it doesn't actually work if you treat the model literally. It doesn't work that way. Right. I mean, if you're interested in these kind of details, you can read the original paper. It's a theoretical paper plus simulations. So I think if you are a senior level economics major, then and you like math, then you should be able to understand it. It's not as far as model goes, it's not actually a particularly complicated model. In the I sent out an email, right? I've uploaded several worked out examples on loss aversion and prospect theory. In those examples, 2 of them are about this particular issue. And I think those you can definitely understand, because it's a very simplified case where we use the numbers given by Kahneman and Tversky, so that we use numbers that they have estimated for prospect theory. We use the same numbers they have estimated, and then you can see that it simply cannot generate the prospect theory, the disposition effect, if you just think about the way this is. Like, start from here, goes up, goes down, it actually do not get prospect disposition effect. So how do you actually explain disposition effect with prospect theory? Okay, so we have talked about that. Okay, so loss aversion means you're very risky initially. Stock return has to be very high to make you invest, and the curvature of utility is small except at the reference point, so you're pretty much just risk averse, risk neutral. So investor might invest more after a gain than a loss. So once again, the estimated numbers provided by Kahneman and Tversky only gives you very shallow risk aversion, very small risk aversion in the gain region. So you pretty much risk neutral. All right. So here's what Barbaros and Sean propose. They propose that actually we're thinking the problem in the wrong way. Now, up to this part, up to so far, we are assuming that the investor, take their like final gain and loss in wealth as what they use to make decision, right? So at the end of the year, I make this much money, that makes me happy. At the end of the year, I lost that much money, that makes me sad. We're basically assuming that, and that's the classical finance assumption too. People just maximizes their wealth over a period of time, and then decide what to do. Perhaps that's actually not the right way to think about it. Perhaps it's better to think about it that people are actually feeling a gain and loss when they actually trade, right? If you allow this option, then I think it makes more sense. It's more realistic. It seems to me that the strongest emotion you feel is at the moment of trade, not at the end of the year, right? Even though that's what traditional finance would assume. But I think most people, the anxiety comes from the moment you press the button to trade. So Barbaros and Sean propose that perhaps the prospect theory, the model you should apply to the moment the investor trades, and only at the moment they trade. That is, if they buy a stock and they never sell it, then there is no feeling of gain and losses. Right? I buy something, I don't trade it at all, then I don't feel any sense of gain or loss. Right? So in finance, we would say the gain loss utility is only over realized profit, not paper gains and losses. Right? So as long as you haven't closed your position, right? As long as you haven't actually traded, then you don't experience any gain loss utility. Right? So now, if you are confining yourself to having gain loss utility only during trade, then you need another utility function that an investor rely on when he buy things, right? Because he only experiences gain loss when he sell things. Then what does he do when he buy things? Well, in Barbara Chang's model, they have the simple normal CRRA utility, right? Constant relative risk aversion. Basically, log utility, right? Just have a log utility. The log utility is going to determine whether you buy or sell. Sorry. The log utility would determine whether you're going to buy. Then when you decide whether to sell, you would take into consideration the gain and loss utility you're going to get. Right? So this part, the second part, the CRRA part, always exists. So you always have this normal looking concave utility that is going to give you part of your utility. When you try to sell, if the stock is at a gain, the gain utility would give you an extra boost in utility. Whereas if you're selling at a loss, the loss utility enters and give you an extra negative portion in utility. So the utility now has two parts. There's a part that always exists, that is CRRA, like log utility. This part always exists. The gain and loss part only enters when you decide to buy or sell, and it gives you an extra part that either makes your utility higher when you're at a gain, or makes it lower when it's at a loss. So this solves the problem because now you don't need a particularly high return to induce the investor to invest. all you need to do is that the return is high enough such that he would invest under a CRR utility. Now, under CRR utility, you pretty much always invest in something. As long as the return is positive, you invest in something. But the amount you invest depends on how high the return is. Right? So both CRRA utility and CARA utility gives you something like that. You invest in something, but the amount or the ratio you invest depends on the return. So now you would get some investment, even if the return is not very high, and then the investor have more incentive to sell at a gain because you get this excitement. If I sell now, I'm going to earn money, and I'm very happy earning money. Right? I'm extra happy when I'm selling at a gain. And then you also get the unwillingness to sell at a loss, because if he do sell at a loss, he is going to experience an extra deduction in utility, which he does not experience if he just keep the losing stock in his portfolio. Right? Yes, he's unhappy that the stock has lost value, but he hasn't sold it yet. He doesn't feel any extra pain. But if he does close his account, then he is going to feel extra pain. So that's how Barbaros and Chong get around this problem. All right. So do we have evidence that disposition effect is actually caused by loss aversion? So we have some evidence. There are experimental evidence, and there are let's see. It's experiment, and there are two experiments. Okay. So this one is done by Camera. So it's a control experiment, and then it's just ask subjects to trade against a computer. The stock movement is predetermined, right? The subjects do not know which one is which one, but it's not. They are trading against a computer that has predetermined stock movement. 6 assets, 14 periods. Right? So experiment 1, which is the line with the solid diamonds, this one, they have free trading. They can do whatever they want. Experiment 2, which is the one with empty triangles, they have automatic forced selling after each period. But there's no trading cost, so you can always buy back what you are being forced to sell, right? So the only difference is this one, you have some attachment, right? Because you have to make the decision of selling. This one, you are being forced to sell. So it's the question of whether you want to buy it back. And what does this experiment find? Okay, so what this find is these are cumulative distribution of disposition coefficient, which is just a measure of the disposition effect. As the closer the disposition coefficient is to 1, you can see the definitions here, the stronger is the disposition effect, right? So people here are very strong. Here, people here have no disposition effect to speak of. This is unknown, because if you are in -1 region, you're selling more often than you're buying. Actually, if you're in the negative region, you're always selling, I think, right? Yeah, you're always selling. So, right. So what do we see? Once again, 1 means has disposition effect. 0 means no disposition effect. -1 means you always sell, never buy. We don't know what that means. This is a cumulative distribution, so you're looking for a vertical part, because vertical means that there are a lot of mass of people in that region. In a cumulative distribution, when you have a vertical region, that means there are a lot of people in that exhibiting that behavior. And for experiment 1, the biggest mass of people is around 1, and you can see there are also a lot of people above 0. If you go below 0, only 30% of the subjects are below 0. Right? So 70% of the subjects sell more often at a gain than a loss. And there are a lot of people around 25% of people really sell a lot more than loss, right? 80% of their sale were in gains, and only 20% were in loss, right? So most people here. If you force people to sell everything, right? If you force liquidate their holdings in each period, then you see a lot less disposition effect. if you have forced liquidation, then people don't typically buy back what they were being forced to sell, right? So that's why the mass of people, the part where the cumulative distribution is going up a lot, is around 0. So most people, after you force them to sell, they don't really buy back losing stocks, right? They don't really buy back losing stocks. Okay, so that's some evidence, but as you see, whenever you have experimental evidence, things are typically not very clear cut. It's not very clean, right? Because there's clearly, for the group that can do anything, you have a wide range of behavior, including ones that you don't really understand what's going on. Why are they selling more often at a loss than at a gain? You don't really understand what they're going on. So it's not a clear cut where you have all the people are no one is selling at a loss. Very few people are selling at both at gains and loss, and like 80% or 90% of people are selling at a gain. That's not the case. It's like kind of a smooth distribution, which makes it less clear cut of what's happening. Furthermore, there's another experiment that shows that it's very similar to the previous one. Is that now this paper looks at the relationship between percentage gain realized and percentage loss realized, and it asks whether there's a relationship between the two. You would actually explain the relationship between the two because in the model we used, in the prospect theory, the same model that makes you want to sell at a gain also wants you to keep at a loss, right? It's the same prospect theory utility. When you sell at a gain, you're happy, so you want to do that. When you're selling at a loss, that you'll be very unhappy, so you don't want to do that. It's the same model. So you should expect that people who sell at a gain would also be the people who are unwilling to sell at a loss. So you only have, right? You would have something like this, right? Let's say you have two types of people, right? Type A, just rational, right? Just like those who just see our utility. Then you would have predict, no disposition effect, simple, no disposition effect. Type B, they have prospect theory utility, right? Then what do? Then what the prediction is? Sell at gain and hold at loss. These two predictions are both coming from the fact that you have prospect theory utility. These are not separate, right? So you would expect that if you run an experiment, look at whether people who are willing to sell at a gain they should also be the ones who are unwilling to sell at a loss. They should be the same people. This experiment suggests that they might not be. What they show you is each dot is one subject, right? Each one subject, and so it shows you the position of the dot is on the horizontal axis, the percentage loss realized, and the vertical axis is the percentage gain realized. So what do you see? Okay, so I've explained that. Okay, so the good part is that if above the 45-degree line are people who are selling more often at gains versus loss. If you're selling exactly 50-50, that you'll be on the 45-degree line. So people on the top of the 45-degree line are people who have a higher percentage gains realized versus percentage loss realized. And so there are more dots there. So that's good. But now, if you look at people who who realize always realize the gains, like always realize the gains. There's a whole variety of dots here. So I think, let's see. Yeah, this one in this paper. So we're talking about how much of the stocks that has gained in value do you sell? Right, so the denominator is a bit different, right? Because in all the previous cases, the denominator is total shares. In this case, I think it's not. This case, it's just of all the stocks you hold that has gained in value, how much of that do you sell? So these people at this point, and this very top, these people are the ones who sell all the stocks that have gained in value. Now, some of their stocks would have lost in value. How much of that do they realize? Well, some people here truly never realize any stock that loses value. But there are also people essentially sell almost everything that has lost in value. In other words, this guy, he sells everything. He sells everything that gains in value. He sells everything that lost in value. Right? Similarly, you can look at people who have never sold anything at loss. Right? It's the green part. These people never sold anything at loss. Do they sell the stocks that have gained in value? Some do, right? Some do. But there are also some people, in particular, this is quite troubling that there's a whole big mass of people here. That means that these people never do anything. They don't sell the gain, nor do they sell a loss. Now, what does that say? One thing you have to note is that it could be depending on the design of the experiment, right? Perhaps the design of the experiment is such that people have very low incentive to sell, right? Because you see that there's a lot of mass of people here. You can see, which means that most people are doing very little, right? They're not really selling the gains. They're not really selling the gains. They're not really selling the loss. So perhaps the experiment design is not very friendly to trading. People just don't want to do anything. They just want to sit there till the end and get whatever they get, right? So that is possible. But this experiment wants to suggest that we're not seeing a very strong correlation between people who hold on to their losing stocks and people who are letting go of their winning stocks. Prospect theory would suggest there's a strong relationship between the two. The people who are willing to let go their winning stocks are also people who are unwilling to let go their losing stocks. Here, that doesn't seem to be a strong correlation, right? So that's why there's always room for further studies, because this is a theory. We believe that this is a theory. Prospect theory is a theory, and then you're using the theory that this is the reason behind disposition effect. It's a theory. So it could be wrong. Maybe disposition effect is actually not prospect theory. This is the leading explanation, doesn't mean it's the right explanation. So there could be there's room for further studies. Huh? Yes. Yeah. So I think it's possible that people they just hold on to things. Yeah, in this experiment. Right. So tendency of doing nothing. I think this is not easy to overcome in an experiment, right? In an experiment, if the reward is not high enough, then they might just sit there and hope and just wait for the experiment reward. Typically, when you attend an experiment, you get something like $30 for showing up, and then you get some extra if you do things right. Maybe they just feel like it's not worth their effort in trading and just sit till the end, and hopefully they will get their $30 and leave. The thing is, in real world data, you can't easily separate different factors, right? In the experiment, the returns are all generated, so you can make it clear to the subjects there's no mean reversion, right? true, like in what I did in the scenario at the very beginning, right? I asked you to do the hypothetical choices. I told you I really generate them randomly with mean return of 0.1 and standard deviation of 0.3. You can do that in an experiment. You can do that in real world. You don't know what necessarily happening in people's mind. Perhaps they really believe in mean reversion. Furthermore, you would have in the real world you would have to control for all the actual trends in the stock price before you can conclude that what's happening. So it's just more difficult to conclude. Okay, so the last paper in this part is one that uses neuroscience. So now the way that the Barbaras and Zhang's theory works is that when you trade, you have an extra burst of utility. That's how it works, right? If you don't trade, then you just have the normal part. So how do we actually measure that? The way you can do it is with neuroimaging. So there's this field called neuroeconomics. It's a very small field because the equipment is very expensive, so it's not easy to do something like this. So what you do in this field is you use an fMRI machine, right, to monitor brain activity when subjects make decision. And the idea is a burst of utility would correspond to an increase in brain activity in a specific region. That's the idea. Our mathematical model suggests you have additional utility at this moment. Let's take a look whether you have additional brain activity at that moment. So fMRI machine, these kind of like machines like that, big machines, they measure blood flow, right? So they measure blood flow. So I have actually done one of these experiments. You basically, yes. What they do is this: they would typically. So this one is from a hospital, so it's not actual one used in an experiment. The one used in experiment typically would have a monitor installed here, and once you're inside, you look at the monitor. They give you a remote control, like one you have playing like PlayStation, and then you just press button to control whatever happens on the screen. Right. So this kind of studies are not just done in, well, actually economics is a minority. Like very few studies in economics use these kind of machines. But neuroscience in general do a lot of these studies. Right. They study a lot of things, like how you control, how your emotion fluctuates, that kind of stuff. So they measure blood flow. Right. Everything is about blood flow. Presumably, if there's an increased blood flow in a part of the brain, that means that that part of your brain is being more active. Right. So it's a 2014 paper in Journal of Finance. So they are measuring a few specific parts of the brain. One is called VMPFC, which is right behind the nose bridge, right, like right behind here. And according to previous research in neuroscience, it signals the value of option, like evaluating different options. Okay. So what do they find? Now, this study is very simple. It's just that you are inserted into an fMRI machine and you just trade an asset, and let's see what happens when you trade at a loss versus trade at a gain. Very similar to what I asked you to do at the very beginning of the class, except you're inside an fMRI machine. And so each dot is one subject. Dot is one subject. And what you're seeing here is on the horizontal axis, it says VMPFC, basically the blood flow, the blood flow in this region when there is a gain, and blood flow in the region when there's a loss. So what this shows you is that it's upward sloping, so there seems to be more blood flow when this says the proportion of gain realized, and this is the proportion of loss realized. So it seems that when the proportion of gain realized is higher, there's more blood flow. And in the proportion of loss realized, there's also more blood flow. So the blood flow for gains is statistically significant. The p-value is 0.001, but the blood flow for loss is not significant. The p-value is 0. Oh no, these are no. I think this is outgoing. Wait, I think it's p-value, right? It's p-value. Yeah, this one is. I think this one is the one that's not obvious. Yeah, the p-value is actually very low. Now, these studies, we can see that there's a lot of noise. Blood flow is messy, right? So you need. So these are so the effect. While there's an average effect, you can see there's a lot of individual heterogeneity here. And they also look at another region, VST, which is at the center of brain, which signals change in expected utility. Well, once again, unless you're a neuroscientist, you have to take their word for it, right? I mean, who knows? Signal change in expected utility. Right. So once again, you're looking at what you're looking at is the average of different of the subjects, because what they want to do now is they want to have a timeline, right? The number of seconds after the decision was made, right? So the intersection of the vertical axis and the horizontal axis is the moment the decision was made, and they were saying that look, before the decision was made, so the trading decision, there's not much blood flow in this region. At the moment the decision was made, there's a strong increase in blood flow, and then after the decision was made, there's once again no significant variation in blood flow. So you can see that there seems to be a region of the brain which have significantly more activity when the subject was trading, when the subjects were trading. So the blue line was what happens with gain, and the red line was what happens. Yeah, the blue line was what happens with selling at a gain, and this one is just what happens if you're holding at a gain. So the red line is basically a control for what the red line, right? Because what you might concern with is that when the subject was inside the machine, this region of the brain simply lights up whenever they see something on the screen, right? Something happens. So this is a control that shows you, well, if they're not trading, nothing particular happens. It's still higher than 0, right? As you can see, there's still a slight uptick here, right? Still a slight uptick here, but the uptick is not as strong as when they're actually selling. So these are confidence intervals, right? So the confidence intervals don't overlap, suggesting that the difference would be statistically significant. The subject's brain actually experiences a lot more activities when they are trading versus not trading. All right. There are not a lot of studies like this, which shows you that different parts of people's brain actually lights up when they do a particular activity. What the authors of this paper primarily want to show is that the model. So you can't see it here. It's just a Freeman et al. There are quite a few co-authors, but I think either Barbaras or Chang is one of them. So basically what they want to show is that the Barbaras and Chang's model actually makes sense, that people actually experience additional utility when they trade at the moment of trade, right? So this is what they read. So this is what they really want to show, that when you trade, you actually experience additional utility, and the way they try to proxy for that is brain activity. Your brain has more activity at the moment of trade, right? All right. So that's all for this